Hello guys, Takwa FX here again. Good morning, good afternoon, good evening, according to where you are watching me from. I'm a Nigerian trader trying to document my process here on YouTube. So let me tell you guys, please don't mind my voice. I've been ill for a while. So let me take you guys on market structure. How because the foundation when it comes to trading, it's market structure. You must know how to map out your market structure before you even talk about how to add other stuff to it, maybe like indicator or any other thing. So before we start guys, do me a favor by clicking on the like button, turn on the notification bell, so whenever I drop a new video you'll be the first to view and learn something from it. Without further ado, let's get started. So your market structure depends on the kind of trader you are. At times you can start from H1 to mark your market structure, or 4 hour to mark your market structure, or daily if you're a swing trader to mark your market structure. So I'll start from H4. But we have about how many types of market structure? The most ones we do look into is the ranging market and the trading market. That is the two main market structure that we look into. But we have market structure in form of trend line, in form of market is trending upward. Then we have another one. Let's go again. We have this very one. We have this particular one here. This very one is trending upward. If you see something like this, meaning this market was going down, before we know it breaks structure to the upside. This simply means that this market, on return, it may return to any place from this. It may return to this place for you to take a trade, or at times it returns to this level and start rallies up. That is, it break to the upside. This is what they really call break and retest. It will break to the upside, and and it will come back and still replace this level and then going up again. So this very one is a trending market, meaning the market is trending upward. So let's look for another types of market structure. We have another one like this. We have something like this again. Have something like this. We have something like this. It's not breaking to the upside, it's not breaking to the downside. The market will just be in a range. This one is called sideways market. In this kind of market, it's not advisable for a beginner to trade because they won't really know when the market will take out either the upside or the downside. You don't really have a clue of what the market is about doing. So in this type of market, you stay out of this type of market because this very one is called consolidation, consolidating market. Now we know that this market is in a range, is consolidating, and we have another one which is like this. We have this. Sorry guys, I'm not good at drawing, pardon me. I'm not too good at drawing, pardon me. So wow, I've missed it. So we have this type of market again. This have this type of markets. This one is a trending market, but this one is a bearish market. It's trending downward. So the only time we are trading on this type of market is for us to be expecting the market to either pulls back to this range and give us a continuation entry, pulling back to this range there and give us a continuation entry to the upside, or we expect it to pull to comes back to the discount, or maybe we may see imbalances around this zone, then we we will take our trade. We take our trade from that zone. We wait for the market to pull back to this point. Once the market pulls back to this point, we will look for the reason. We look for a reason for us to take a trade. We look for a reason, then we take a trade back to the direction of where the trend was going. So this is another type of market structure. So this is the type I'm looking at. I like this type. This is the type I do look for in the market. This very one, this is the one I do trade on the market. So let's go to the real chart to check the thing we're drawing here, if we can find market structure in real chart. I'm going to be using H4 for this. So I'm on my H4 right now. On H4, GBP USD here. This is GBP USD. Here is on H4. On this pair, we can see something like this. This was the last high the market created before moving to the downside. This was the last high the market created before moving to the upside. On our 4-hour chart, you can see that this market, it closed with a wick. But if we go to H4, if we go to H1, sorry, if we move to our H1, we will notice that this market actually closed not only with a wick, it closed above that zone. And then if you notice that the market closed above that zone, this is the point you will interested in, the 4-hour, where the move started from. That is where you'll be interested on. You have to be patient for you to take a trade. So going back to the H4, you can see that the zone that lead to break of that structure was this one. Then you mark it out. Then you scale down to your M15. You can have two things for you to enter this trade with. It's either you wait for the market to come back. Let's go to like 30 minutes chart, but normally I use M15. So here was the zone on your M15. Once you scale down to your M15, this is the zone you will meet. So on this zone, you can see that as the market tap into this, because the reason why I really marked that very candle is because of this imbalance. There's imbalance here between here and here. We have this space where no market has closed inside, no week, nothing. That area becomes our imbalance. So as the market come into this zone, it gives you an engulfing pattern. It closes out with engulfing pattern. The market closes with an engulfing pattern. Here is engulfing pattern. If you don't know, this is the candle I'm talking about. I have to scale it out because it's not everybody that knows engulfing, especially as a beginner. So that candle here is our engulfing candle because it closed above another candle. So at the close of that candle, that is where you take your entry. You place your trade like this. You place your trade like this. Your stop loss come below it, and you TP above where the market comes from. This is the high the market come from. So you trigger above it, or you can go with this, or above the zone. And this market was able to give you 1:8 RR by just using that concept. Another thing we will look for is for us to wait for the market to come back to this zone. As it come back to this zone, it breaks structure to the upside. You can see it breaks structure to the upside. So as it breaks structure to the upside, you marked the area that lead to break of the structure to the upside, which is this very, let me shape this thing. That is the one I like using. As the market come in, it breaks structure to the upside. As it tap into the zone, it breaks structure to the upside. The last low it will drop before it needs to break up structure to the upside. It was this one. It was this one with a very nice imbalance. You mark out this one. So this is where you'll be waiting for. You wait for market to come into this zone for you to take your trade to the upside. So once the market come into the zone, you take your trade. Once the market come in, you take your trade and you TP where it comes from. I hope this is understood. So that is the only thing you would do. So that is market structure for you. So guys, please like, comment on the channel, share, click and turn on the notification bell so that whenever I drop a new video, you'll be the first to view and learn something from it. I remain Aqua FX as I sign out from here. Thank you guys.